Futures higher as yields in oil fall. 30 minutes till the start of the cash trade. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, Nvidia earnings could determine whether the chip rally still has room to run or could reignite fears of a bubble.
And Goldman may take the leading role of the biggest IPO ever. SpaceX is set to file publicly as soon as today.
Plus, Target posted its biggest sales gain in 4 years, but shares fall as the retailer flags cost challenges.
A lot of retail earnings. The big one's going to be Nvidia, though. Typically, though, when Nvidia reports, it hasn't really in recent years and quarters acted as a catalyst for the entirety of the market because of the run-up it's had. It is trading up higher in the pre-market, 1.5%. It's aiming to keep the AI rally going, which has faltered in recent days. It has a high bar to meet with sales growth expectations above 80% year over year, Matt.
But it has moved. The stock has moved significantly, even though it's such a behemoth, right?
Yes.
$5.3 trillion company right now.
The swings it has in just one day are pretty remarkable.
Yeah, it'll be amazing to watch. That's after the bell today. Ahead of those Nvidia results, we're looking at chip stocks that are higher, and Micron is gaining. Advanced Micro Devices is gaining. Qualcomm is gaining, on pace to break a 3-day losing streak, although they've had an incredible year, right? Micron has basically almost doubled year to date. I was looking at SanDisk earlier. It's up like 480% year to date. So a lot of these chip makers are just off to the races.
And its 12-month forward PE ratio is 7.3.
For Micron.
For Micron,
yeah.
After the most recent sell-off. Let's discuss earnings. Bloomberg Tech co-host Ed Ludlow is joining us. Ed, it's the big one. It's Nvidia after the bell. I was just saying the bar is really high. So where exactly is that bar?
Yeah, the bar's really high, but with the expectation that, it doesn't really matter what happens in the quarter gone. They want Jensen Huang to give some guidance, right? So top line growth of 80%, EPS growth 85%, in an environment where the demand, as Jensen Huang told us on Monday, right, is vastly outpacing supply. That's the status quo. There are some overhangs on the stock, right? In most recently China, like what you guys were saying is so spot on. Through yesterday's close, in aggregate on the stocks, we were flirting with correction territory just from Friday, Monday, Tuesday.
Wow. Because
there wasn't really this net outcome from the president and his trip to China and Jensen going with him. We didn't have any certainty on that. But yeah, it's very elevated for sure.
The thing is, analysts expect them to beat and raise, right?
Always, yeah.
Which begs the question, why don't analysts just raise their estimates? But also, China could be, not for the reporting quarter, but for the outlook, a really important piece? Or is China actually a small piece for the outlook, Ed?
Yeah, it's more psychological than anything else. Like, the base case assumption right now is zero revenues from China, and Nvidia has talked regularly about it being a $50 billion opportunity. But that's what I mean. That's the part that needs to be reconciled. Because at Nvidia's own conference in March, Jensen Huang was on stage talking about the idea that because they had those licenses from the US and they saw an indication they would get orders from China, they ramped up the supply chain. But clearly it's up to China. And China right now's position, based on what the president said and based on what Jensen told me on Monday, is they want to protect their own domestic players. So it doesn't move the needle, really, in the modeling for the sell side. It's just this idea that Jensen Huang and Nvidia is right at the heart of the broader China story.
So much for the $50 billion TAM.
Right.
Everyone was so pumped, Ed. I've been saying the entire time, for over a year, okay, so they can sell into China, but the Chinese government keeps telling companies not to buy these things, and everybody was poo-pooing, my negativity here. It turns out that parade has been rained on.
The thing is, there was a time where China was a critically important data center market, right, prior to the AI revolution. But there is an opportunity there, right? Tencent, Alibaba, Baidu are massive companies that can be seen as being at hyperscale, with a similar data center footprint to those here in the United States. The opportunity is there. And they, as Jensen Huang would put it more academically, 50% of the world's AI research is being done out of China or by Chinese engineers and scientists. So that kind of is the why of why they want to be in it.
All right. Ed, thanks so much for joining us. Bloomberg Tech co-host Ed Ludlow. We're going to talk about SpaceX a little bit later, expecting more details on the IPO, or we'll talk about it right now, actually. Goldman Sachs said to be leading SpaceX's mega IPO, with the company expected to file publicly today. Bloomberg senior reporter Bailey Lipschultz has been covering this story for us. He joins us now. And Bailey, it's interesting, because they have the Starship launch. It was planned for yesterday, then today. Now it's been moved to tomorrow. But it's so critically important, and the fact that they're going to have this public filing at the same time is pretty courageous.
It's pretty courageous, Matt. But I have been talking to bankers and investors over the last few days about this, and I've made that point to them, and their counterpoint is, well, at some point they're going to launch Starship. It doesn't matter if it's right before or right after the filing. It doesn't change the content of that S1 filing. And broadly speaking, if you were someone who can write, $5 to $10 billion check, and we're down in Starbase, Texas a few weeks ago, meeting with the management team, sitting in on the presentation with Elon Musk, it doesn't really matter as much to some of them as it relates to the exact timing and figuring this out when you look at just the kind of gargantuan lead that SpaceX has against any other peers in getting massive rockets into space.
Bailey, what might we learn with this filing that we don't already know yet with SpaceX and their plans to go public?
The biggest thing, Dani, when I talk to investors is, how is the lockup going to be structured? Will it be something like what we saw with Cerebras, where they're letting out a few million shares every day, depending on how the stock performs in the aftermarket? That's critically important. And if there's any color or update on allocation to retail, whether they name out the likes of a Robinhood or SoFi, if there's any type of detail on how they could, put shares into the accounts kind of more primarily for people who own Tesla stock or own the Tesla cars. There's a lot of things, just kind of those nuances are top of mind from investors' perspective, just given how much has already been kind of reported in the media from us and some of our competitors.
Well, we'll look for that filing as soon as today. Bailey, thank you so much. Bloomberg senior reporter Bailey Lipschultz. So pleased to say that joining us now is HSBC Chief Multi-Asset Strategist Max Kettner. Max, great to see you in the flesh. And look, you've been really forward in saying we are max bullish, and higher yields don't impact us because, well, one reason has been earnings are so strong. Then how important is Nvidia today to keep the good vibes earnings continuing on?
Yeah, I think it's very, very important. Like Nvidia today, if that were to disappoint, I think that probably would put a lot of the AI and the CapEx story in question. But let's face it, when we look at the tech and AI story, and particularly now this earnings season, you look at within the tech sector, within the S&P, your earnings beat rate has been 100%. Which is
that right?
insane.
100%?
It's like 100%. Like, we've got every single company that beat earnings expectations. So it's kind of tough to be like sitting there like, oh, I think Nvidia is going to be the mother of all downside surprises.
Max,
like,
do you sometimes
really?
question the work of the analysts
Never.
who make up these estimates?
I would never question myself.
I mean, if you are, a longtime analyst and you've seen a company beat whatever number you put out by 20% every single quarter, at some point, don't you say, hang on a second, let me add 20% to my estimate?
Yeah, but look, I think it also depends on the earnings guidance. I think, right, corporates are probably pretty good.
But you know they're guiding down.
That is true. Yeah,
right?
That is true. But, this is, I always say, look, don't hate the play it, right? Don't hate the game. Like, that's what we deal
Max,
with.
if somebody beats you every single time with a drop shot, do you not go to net?
No, of course not. You stay all the way behind.
You stay on the baseline, right?
That's what you do. You
That's
stay
the way to
all
keep
the way
your
behind
job.
because, hey, this is, at the end of the day, this is how you how you work out.
Keep management of the companies happy, keep them talking to you with not, with
it's
estimates
so
that set the bar low. Putting that aside, the other thing we're talking about is this massive IPO filing we're likely to get. So you get SpaceX, which is going to be the biggest IPO ever. Well, we're also likely to get OpenAI and Anthropic this year. How is the market going to digest these mega IPOs? Is it a reason to be concerned? Is maybe we sell off other things and passive portfolios to make room for these big companies?
So I think there is two ways to look at it, right? The bearish side is the supply angle that you've just touched on, so that actually we need to free up some space, like we need to sell some Tesla to buy SpaceX, something like that. I think the more positive side is if one of those really does come in at 1 trillion or above 1 trillion, I mean, we're going to have a heck of an IPO. Like, imagine if you guys at Bloomberg are publishing those headlines and like, hey, look at this, 1 trillion IPO, and actually the stock is up on the first day. Happy days. I mean, that is a heck of a bullish headline if you think about it. So, it depends what narrative you want to spin, I think. I think the supply, the supply story is a little bit overblown given how much money there still is on the sidelines. Remember, 6 months ago, one of the dominating narratives around AI concerns first was, is AI, are we overspending on CapEx? We now realized, oh God, we're not, and we're actually short of chips. The second, probably more pressing narrative was funding concerns. Those guys, they're running out of net cash. They need to issue debt now. And where are going to get the money from? And particularly companies like Oracle, right? Oracle was all in the weeds of all these concerns. And then you had Oracle come out in February and say, look, we're going to raise $25 billion in debt, and you have $130 billion of orders. That just tells you how much money there is. When the number one sort of poster child, oh my God, this is the one where we're really concerned about. Yeah. And they've got an order book of $130 billion. Why are we concerned about this? I think the supply story around, oh yeah, but we need to sell all this other stuff to just buy those IPOs, I think that's a little bit overblown.
By the way, rates don't matter, right? 4.6, 4.7% on the 10-year, 5 and change on the 30. Doesn't matter, right?
No, I think, look, from here onwards, if I had a blank sheet of paper and you said, right, I'm going to get, Matt Miller gives me $100 million of his immense wealth today to invest, I'd say, you know what? But actually, if you look at the ultimate terminal rate expectations as of today, which is sort of short end, right, front end expectations in 3 years' time. If you look at that, that's close to 4%. Effective Fed funds is at 363. So effectively, you're pricing 1.5 hikes 3 years out already. So what you would need to say, as of today, I think that's going to be 2.5, 3, 4 hikes. That's a bit much, right? 1.5 hikes kind of seems like, yeah, that could happen. That's a bit of a risk premium baked in there. But to go even higher, to be even more concerned from as we stand today, you're going to have to be a heck of a lot more hawkish from where we stand today. That really doesn't stack up.
It's tough. Okay, Max, we're going to keep you with us. Max Kettner from HSBC, staying through the break. We are looking at markets that are, well, futures that are higher right now as rates come down a little. You can see the 10-year down 2 basis points and Brent crude off about $3. Let's get a look at some of the single stock stories we're following for you. Homebuilder Toll Brothers raising its full-year guidance as orders hit their highest in 2 years, and Toll is up 4% in the pre-market.
Then there was Cava, the fast casual Mediterranean slop bowl, raising its annual sales outlook as it saw a rebound in demand despite consumers getting cautious around budgets. By the way, I say that with love. I love a slop bowl.
Wow, 11%. VF Corp says its Vans direct-to-consumer business, I'm talking about the shoes made famous by Jeff Spicoli, has returned to growth for the first time in 4 years. Max is actually wearing some under the desk right now.
The checkered Vans.
I guarantee he owns a pair. Coming up, Target falls as executives warn about a tough second quarter. We got Romaine Bostick for you next. This is Bloomberg Open Interest. Let's get now to high interest. Look at what's making headlines around the world. Iran warns it would retaliate beyond the Middle East if the U.S. or Israel restart attacks on the Islamic Republic. The warning follows renewed threats from President Trump, who said the U.S. may have to give them another big hit if Tehran rejects American peace terms. When asked how long he would wait, he said 2 or 3 days, maybe Friday, Saturday, Sunday, something maybe early next week. So we'll watch for that. In the latest congressional primary results, President Trump's hand-picked candidate for Northern Kentucky, Ed Galrine, defeats longtime Republican House member Thomas Massie. It's the clearest sign yet of Trump's grip over solid Republican states, as well as the massive influence of pro-Israel money in middle American races. There were tens of millions of dollars of Israeli-linked cash that fueled Galrine's defeat and fought against Thomas Massie. And in terms of Standard Chartered, the CEO, Bill Withers, tries to reassure employees after backlash over his remarks suggesting AI could replace lower-value human capital. In a memo to staff, Winters wrote, "I know this may be unsettling when reduced to simple headlines or a quote out of context." But of course, we gave you the full quote in context yesterday. We played the sound of it. You know?
The quote was that they're
clear.
trying to get rid of lower value human capital and replace it with like actual capital. But like that was the quote, so I don't know how you take that out of context.
Exactly.
Anyway.
He's welcome to come on the program and push back.
He often does join Bloomberg, and I hope he does soon. To the consumer story, which, let's be honest, is kind of related. Target, TJX, and Lowe's all reporting earnings this morning. Target had a good quarter. It raised its outlook, it had strong sales, but shares turned negative quickly once the earnings call began. Joining us now is Romain Bostick, co-host of The Close. I mean, Romain, it was a pretty quick turnaround. Is this just because their outlook is not as sunny?
Yeah, I mean, this is really the tale of two stories. What happened in the most recent quarter, the last 3 months, and what's actually happening in the here and now. In the most recent quarters, you're talking about the best comp sales growth in about 5 quarters, and quite frankly, one of the best performances they've had in about 4 years, 6%. A new CEO, he focused on baby toys, baby products, toys, as well as health products, and that boosted sales. Then the conference call started. James Lee, the CFO, started talking about gas prices, talking about the resiliency of the consumer, talking about tough comparisons for their fiscal second quarter, which is the quarter that ends in July. And you saw the shares go from up 4 or 5% in the pre-market to now down 4 or 5% in the pre-market. And that's going to be the story for a lot of retailers here. The first quarter, the first few months of this year probably did all right. What's up ahead for the second half? That's a big question mark.
Yeah, and TJ Maxx had a similar message that fuel costs are going to impact the outlook. Obviously, TJ Maxx, the stock has been on a tear over the last 5 years. It's up 140% total return, but it's starting to lag a little bit.
Yeah, TJ Maxx is an interesting story. I mean, they basically comp sales came in double what the street was looking for. We're talking about 6% growth. They actually tend to benefit, though, when you have economic downturns because they have sort of the low-income consumer that goes there for the discounts. The high-end consumer trades down to TJX, and they actually tend to improve margins historically during economic downturns because the way they source their goods, which is basically discounted merchandise from other brands that are struggling, they actually are able to pick up that merchandise at a better discount. So potentially they could actually see a big upside if we do get to an economic downturn.
By the way, Romain, we're very much so looking forward to the close today. We are every day, but you have Nvidia earnings. It's a big one.
It's going to be a big one here. No retail story there, not yet, unless Matt, you're out buying GPUs for your...
No, well, I mean, the retail story, I think, is, Max Kettner and this market investing in the demise of the consumer, right?
The demise of the consumer.
Low-value human capital is going to be the loser after AI, takes over.
Well, you heard
our
it from
jobs.
Bill Withers, and have you seen all of the commencement speeches, all trying to sort of let them know? I've been to 2 commencement speeches over the last couple weeks. It's kind of interesting, the reaction by the audience relative to what the speakers are talking about with regards to the future.
I also think that's interesting because my theory is that all of the young adults graduating from college right now have had 2 years to do nothing but play around with AI. And they're all going to be much better at this than all of us ever were. Anyway, I'll end that rant. Romain, really looking forward to the close today. That's Romain Bostick, co-host of The Close. Catch him from 3 p.m. New York time. It's one you have to watch today, as you do every day, but they'll walk you through Nvidia's earnings. Still at the desk is HSBC Chief Multi-Asset Strategist, Max Kettner. Max, it's something I was talking with Peter Orszag yesterday of Lazard, who basically had before said we're at this roadrunner moment where higher energy prices haven't yet impacted the global economy. And yesterday he said it's happening. Higher prices are now finally starting to impact us. You can kind of feel it in what Romain was talking about with target earnings. Are we finally starting to see the impact of inflation more broadly?
I think on growth, we've got to be way more nuanced. I think it depends whether you are a smaller economy. If you look at the likes of ASEAN, if you look at those smaller, open Asian economies, I think they're really struggling. Right? And we've seen that early on, that they've implemented those policies, fuel controls and so on. I think in Europe, we are starting to see it, definitely, right? We are starting to see some of the business surveys down, right? Business commentary also being a lot more concerned. I think consumer confidence, which is more correlated in Europe compared to actual spending, there we are seeing some influence already, right? And we are seeing that reflected also in consensus estimates for growth, right? For top-down growth, absolutely. I think in the US, it's much, much less the case because let's remember what we're facing in the US is both for corporates and for consumers is an incredibly K-shaped economy that at the end of the day, for the numbers that we care about, I care about my Bloomberg terminal, give me that one retail sales number, give me that one PCE number, quarterly PCE number. What's that driven by? That's driven by the upper 10, 20%. It's not driven by the lower 20, 30% in terms of incomes. And they're doing absolutely fine because they're not really that exposed to what is happening with wages, what is happening with energy prices. They're exposed to the wealth effect. Equity's up now, that's helped, right? And look at the tax refunds. Tax refunds are running, you guys know that, they're running almost 20% ahead of last year. Most of that money goes to the upper 50%. So actually in the US, we have a lot of tailwinds for that one, what's really driving that one aggregate consumption number. And the other thing that I would add is, let's remember that when you look at things like weekly retail sales, like the Chicago Fed one or the like-for-like retail sales, we look at year over year. This time last year, we had a sugar rush of activity because of front-loaded activity because of tariffs. Remember that, right? Last year we had, oh God, everyone's trying to get ahead of tariffs. June and July, we had surprise indices coming off. We had a bit of a lull, right? Because this front-loaded activity was coming off a bit. I think there is a risk for the US, given those lower comps in the next 2-3 months, that actually growth will be looking even better because you've got good activity, but lower base effects in the next 2-3 months.
But Max, what about, so I'm looking at the S&P and the top companies by weighting. Obviously, Nvidia doesn't, those sales are going to be great no matter what oil or jet fuel shortages there are in Asia and Europe. But Apple, Microsoft, Amazon, Google, I mean, these companies get revenue from overseas, right? It's even worse if you look at the Dow Jones Industrial Average. You've got Caterpillar there. You've got McDonald's. You've got Visa, American Express. These are companies that get revenue from overseas. So if Asia and Europe have a problem, does it eventually come back to U.S. indexes?
I think to a certain degree, maybe, yeah. Right, like for those, particularly for Europe, I think if there is some issues, particularly on the chip supply chain with Asia, right, coming and particularly for something like Samsung with the strikes, yeah, that is, I think, a bit of an issue. Is that enough to make you bearish? I'd be doubting that, to be honest, because at the end of the day, like when you look at the S&P, I think there is going to be quite a few names that are struggling. But let's remember, if you look, for example, at the last the bottom half of the S&P, the last 250 names, that is 8% of market cap.
Yeah.
Right? So you've got 50% of the names accounting for less than a tenth of the market cap. So yeah, those companies, they're probably going to tell us, yeah, we're a bit struggling. But does it matter? Does that drive the indices? That's the K-shape, right? It's not only consumption that is K-shaped, it's also corporates that are K-shaped. And some of that stuff, right, I would say the more interesting and the more pressing issue probably is when people say, oh, there's no differentiation price tag. There is. You are seeing those guys, right? You are seeing those tech companies that are doing the capex. They are underperforming compared to your chips, your memory names. So it's not like, oh yeah, everything that's tech and everything that's Max 7 just goes up every day 3% and be happy. No, like we are seeing those names that are doing the capex, that are spending the money, they are underperforming quite dramatically compared to the ones that are receiving the money.
Does that mean you should also, considering it's this pillar really that's supporting the market, that you should either just not be buying, not touching, or even outright shorting consumer things, considering, I don't know, there's stories of earnings Romain was just talking about, issues with the labor market maybe into it. Reuters reporting this morning that they're cutting 17% of their jobs to streamline ops. It feels like something has turned in this labor market. There was a story that for some jobs at Deloitte and Zoom, they're cutting maternity and paternity benefits, which feels really crazy.
Only for the poorest workers, though. Right? Only for the workers who need it most.
Yeah, correct. I mean, only a minute here, Max, but it feels like something is turning, and maybe that's a reason to be bearish consumer-related names.
I mean, at the moment, because we do have that geopolitical uncertainty, yeah, maybe you want to stay out of those names, but also let's remember that the earnings season, we've got an almost 85% beat rate. Like this earnings season now, we've inflected higher, right? We have an inflection higher from a high base. This is the sort of earnings season that you normally see in 2009 or in 2020, right, 2021, after a recession from a low base. We've had an inflection higher from a high base. The one thing that's been lagging is price action. So I would say actually the next step is lean into a broad-based recovery, lean into those cyclical names. Look at transport, look at home builders, look at XRT at retail. All of that stuff has been actually lagging so far.
Okay.
I think that's the next trade.
Max, thank you so much for joining us. Such a pleasure to have you. HSBC's Max Kettner.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We are looking at futures that are higher here as we await Nvidia earnings. That's after the bell, right? But we do see yields coming down a little bit, oil prices coming down a little bit, and we dropped in the cash trade yesterday. So a bit of a bounce from there on the S&P 0.2, on the NASDAQ 0.5%. An IPO at the New York Stock Exchange. Lincoln International, mid-level investment bank, raising almost $500 million. I think $420 or so million in an IPO. So a lot of pats on the back there. Down at the NASDAQ, you've got Forbes ringing the bell, and there's no signage to explain why. And this guy is wearing a fedora, but we'll forgive him for that because they put out a list of the 50 top AI companies, and I'm excited to read it.
Yeah.
I have to say, I care. So
More
maybe
than
I'll
the
buy.
fedora?
It outweighs the fedora, but only a little bit. I might actually buy a copy of the paper magazine.
Whoa, when's the last time you bought a magazine? Like, I can't even remember.
I buy them a lot, yeah.
I mean, I pick up like a Business Week here in the office, but I'm not buying them.
The Economist, Road and Track, Car and Driver.
Can you get them all online? Why do you need the physical one?
Because I like to hold it. And if I'm on a plane, there's that point after takeoff and before landing when you can't use your phone, so.
Oh, they all got internet now. They all have Wi-Fi. Anyway, I'm looking at Nvidia this morning. It's only up 0.5%. It was up more in the pre-market. It's going to have its earnings, of course, after the bell today. Can it keep the AI rally going? It has a high bar to meet. Sales growth expectations are above 80% year over year, and you tend to get some big swings priced into their earnings, post-day earnings session, Matt.
I'm looking at a headline here. James Murdoch buys New York Magazine, so he apparently wants that paper as well. Vox Media Podcast Network and Vox. So Murdoch making some moves. Target also posts its biggest sales gain in 4 years, but the shares, you can see, down 5.5%. As the retailer, Romain Bostic was just explaining to us, flags cost challenges in the current quarter. So it's not only oil that's become more expensive. Obviously, the price of gas. I filled up for $6.36 a gallon the other day. Put $110 worth of gas in my Challenger. Plastics, fertilizer, it's going to come through in food prices, so it's starting to hit, according to Target and TJ Maxx, the bottom line a bit. Joining us at the desk is Citi U.S. equity strategist Scott Chronert. And Scott, I guess those little inflation concerns, little yield concerns, not enough really to put a stop to this incredible rally. We closed still at 73.53 yesterday.
Yeah, I mean, look, we're bouncing, off of a pretty good move, I think, over the past couple of months. But look, let's be very clear about what we're looking at with the S&P 500. It's a bifurcated market. You have to make two market calls to essentially get the right perspective on this. You got half of the index that's trading off of the AI theme. I think that's pretty well identified at this point. Earnings there have been very strong.
Or like 10 companies?
Well, either way, okay, the market caps,
10
and
companies
the weights
is
come
half
down.
The index.
Well, as a very direct, it's probably even broader than that, okay, yeah. I guess would be the point. You get into some sectors, such as industrials, and trying to weave through which one's AI direct and which one's just sort of second or third derivative. We can debate that. But the point here is that you've got that half of the market that's beating to a pretty clear playbook. The beat and raise, the revisions, the positive trajectories are all very much in place. The other half of the index is actually trading much like you would expect if we told you that you're going to have an Iran conflict with higher oil prices, the inflation read-throughs, and now the interest rate bump. It's all trading much more in line with how we saw the second half of 22 unfold. Okay, so essentially the playbook from here is, okay, how do you think of these two components of the market from here? Our view is pretty straightforward. We think on the heels of the Q1 run that's driven this tech component, it probably needs to digest those gains. But it's premature to come back and call a coast as clear for the other half of the market. So that kind of keeps us a little bit close to the best short term, but it's with an underlying constructive view towards the balance of the year.
Is there any mechanism whatsoever that the other half of the market in its struggles impact your overall outlook for what equities do this year? Or is big tech and AI and the spending there just so dominant that it can continue to mask it?
So this is really interesting because we talk about this a lot internally with the team. It's like, well, okay, you know, what's one of the antidotes to higher inflation concerns and higher interest rate concerns on valuation? Well, it's earnings growth, right? So the stronger the earnings growth, you offset what you think would be the valuation headwind of higher rates. So we've had that, right? But you get to a point where the lift gets harder and harder. So a 4.5% 10-year going to 460. If we get to 480 en route to 5, it's probably a little bit different storyline. You're going to have to acknowledge, particularly in the heels of the Q1 earnings strength, that part of the market needs to digest.
By the way, could that happen after Nvidia earnings? Because we kind of have this lull in earnings post Nvidia of like big things that could catalyze this market higher.
I mean, if I were to script this out perfectly, I think we back and fill into the end of the quarter, right? So we get the Nvidia earnings. I expect that we're going to see a very solid result. I think these companies are very astute, and at the end of each quarter, they're leaving something in the tank for next quarter. So I think we've got that part pretty well identified. As far as that goes, though, it's going to be, in my mind, less and less about the actual amount of the upside and more about the persistence and visibility of the forward trajectories, right? So the way we're thinking about the NASDAQ right now is that, and the AI build-out, is that you're probably pricing in a good chunk of what earnings expectations should be for 26 and 27. Not sure we're pricing in 28, 29. So the persistence of the CapEx tailwind and the spending around this ultimately is what becomes mission critical. We think we keep coming back to that. We want these periods of pullbacks to buy into that.
At what point do higher prices and higher rates actually hit this market, though? I mean, at some point, after putting in $100 to the tank of my Challenger and spending God knows how many hundreds of dollars at Costco for groceries, I'm not going to be able to pay my $20 a month for OpenAI's ChatGPT, right?
Right. So those all become issues that we're going to have to contend with, and that's where you fall back on, okay, what's the duration of the conflict? At what point do you begin to unleash some of the supply that's waiting to come on the other side of the Iran conflict? And that's the big imponderable. That's what we're all contending with right now. It's really interesting, though, on the consumer component. We were looking at this. We wrote about it over the weekend. You look at consumer discretionary, and the earnings revisions have been persistently negative for over a year now. But this isn't a new phenomenon. We've been navigating an increasingly complex situation around the consumer. Yes, we got wealth effect helping the higher end, and we know that the lower end is being encumbered by any number of forces, higher oil prices, inflation, and so forth. So at some point, you do need to get a line of sight towards end of the Iran conflict and oil prices. And so, heck, I'm watching the oil futures curve more than I have in quite some time. And what we really want to see is conviction that you're seeing 100 plus crude on this path down to sort of a $70, plus or minus level. We're not there yet. So that becomes the key point here, and that's why, honestly, I think a lot of my peers have been raising targets for the S&P. I'm not inclined to do that just yet.
It does feel like we keep moving the goalposts, and not you, Scott, but the analyst community as a whole, saying, okay, the worst case scenario is that the Strait of Hormuz gets shut. It gets shut. The worst case scenario is that it lasts 3 months. I mean, now here we are in May, and now it's this language of, well, maybe we can handle it. So what is the timeline in which it becomes a concern?
Yeah, so it's really a good conversation. For the past 2 months, we've been using this frog in the boiling pot of water analogy, where nobody really has the conviction or the visibility to really project it. So you keep waiting. The longer you wait, the more the pot boils, and essentially you really have an issue. So we know that that's out there, but we are starting to handicap it. And so what I would just say in that, I think we look at the U.S. as best house in the global neighborhood around oil dependence or independence, if you will. And we look at big tech as arm's length from this issue. So we still think that within the U.S. stock market, we've got some areas that kind of keep us arm's length from the issue. At some point, though, it does become enough of an issue that we have to recognize it. But here's the trick from my seat. Let's say it extends another 3 months, and then you get the relief from oil prices. Well, what's happening is that at that point, you're going to want to buy and own that part of the market that's been most negatively impacted. And then that begins to set up for a springboard effect down the broadening path. So all of this is timing, right? So that's where we're kind of, fairly smug. We got a 7,700 year-end target. We're not changing that right now. I think we probably get a little bit of a digestion phase here. But as we get further into the year, you begin to get a line of sight to where higher for longer oil prices is an issue that builds up to a point where then when it does release or relief, then you're going to get a snap back the other way. So it still kind of sets us up in our view for a pretty decent risk-on circumstance as the year unfolds.
Okay, Scott, you're going to stick with us. Scott Chronert of Citi. First, though, let's get a check on these equity markets. About 10 minutes into your cash equity trading day, and we are higher, snapping 3 consecutive days of losses where we dropped about 2%. We're only up 0.2%. Breath is somewhat even, but if you are buying into the AI narrative, a pretty good day for you. We have a lot of the chip makers rebounding. Intel, AMD, Micron at the top of the pile in terms of points that they are adding. Nvidia kind of creeping into the top 10 before their earnings after the bell. So again, a lot of chip makers. TJX, they reported earnings. On the downside, you do have some companies that reported earnings. I was looking for Target. There it is. Target down 3.4%. So you also have a lot of other consumer names having a tough day. Costco, Lowe's, Intuit. According to Reuters, they're cutting 17% of their staff and refocusing on AI. Usually that's been good for companies when they announce job cuts, but for Intuit, that's not translating into any sort of gain for them. If you look into the sectors, utilities is really high, but it's all of the power companies. So you could make the argument that's also an AI rebounding. Companies like Dominion Energy, all of these things that are powering data centers. Infotech, I pointed out, Nvidia's up along with the other AI chip names. So most of the sectors are up. The only losers are staples, financials, and materials. Again, some of those consumer-related names. Costco is down, for example, on fears of higher costs and maybe weakness into the future, as Target was pointing out, Matt.
All right, excellent roundup there. When we come back, we're going to get an excellent analyst. Mandeep Singh joins the conversation around the impact of Nvidia's earnings. That earnings report coming out, obviously, after the bell. We're going to focus in on it and keep Scott Chronert from Citi here with us as well. This is Bloomberg Open Interest.
Fifteen minutes into your trading day, let's get you some top calls. What the sell side is saying this morning. First up, we have one on Etsy, upgraded to a buy from neutral at already following earnings. Analysts see opportunity in its turnaround efforts, similar to what eBay did last year. And as far as we know, GameStop is not trying to buy them too. Etsy shares up only 0.5%. Next up, Newell Brands downgraded to underweight from equal weight at Morgan Stanley. Analysts say that the company behind Rubbermaid and Sharpie face cost pressures amid the Iran war. And finally, Cigna cut to a hold from a buy at Deutsche Bank. The analysts say that the health insurer faces uncertainty as it transitions a part of its insurance portfolio. Shares that were up 2%. Is this Cigna? That doesn't look like Cigna. Surely not.
CIA Energetica de Minas Gerais.
That can't be right.
I don't think that's Cigna.
I don't think that's correct. Anyway, Deutsche Bank has got Cigna.
Yeah, no, Cigna, the ticker is CI, and the stock is currently up 0.2%. So just a tenth of that move. Nvidia's earnings are set to test whether the AI stock rally still has fuel or is nearing the breaking point. Let's discuss expectations and impact on the broader market. We have back at the desk with us Citi U.S. equity strategist Scott Chronert, as well as via satellite, Bloomberg Intelligence, global head of tech coverage, Mandeep Singh. So, Mandeep, you have yet to weigh in on this with us. Obviously, analysts are expecting them to beat and raise. Can they meet that expectation? Are we still seeing, pricing power and a growing TAM?
Yeah, look, Google yesterday gave a data point. Their token consumption has grown almost 7x in the past 12 months. And we know Google TPUs is about 30% of the accelerator market. Nvidia is almost 70%. And from that perspective, when a market is growing 7x, Even if Nvidia doubles the supply this year, you can see, the demand far exceeds the supply of all these accelerators. And so from that perspective, with all the memory shortage and power constraints, this market continues to grow, very nicely. And I think that will be reflected in Nvidia's results.
This is the thing, Scott, to bring you in is Nvidia, Micron, all of these AI-related companies are seeing earnings grow so rapidly, even though they've run up massively too. Micron is still trading at something like a 7 times 12-month forward earnings. So how do you distinguish whether you're nervous about the big run-up or whether you look at these stocks and say, hey, they're really cheap and still trading at a bargain?
Yeah, for me, it always comes down to time frames. And we like to pull out PEG ratios when we're trying to get our heads around this. And PEG ratios aren't necessarily predictive, but they are very explanatory. Right now, when you look at the NASDAQ 100, which is going to include a lot of these, you're looking at a PEG ratio that's the lowest literally it's been since 2012, okay? So essentially, what does that tell us? That tells us that there's a cyclical expectation that's still being built into the price action whereby, yeah, we're discounting what you think earnings are going to be this year or maybe next, but I don't think it yet allows for the persistence of this CapEx-related playbook to take us out to the end of the decade. So again, that's the back and fill around the strong quarters, but then the power ahead, the surge ahead is still that this picks and shovels play presumably has a long way to go, and it's not yet fully reflected in the valuations.
That's right. So the term power makes me think of, and picks and shovels, really the bottlenecks here. So what are the other bottlenecks, Mandeep, in terms of Nvidia's earnings report? Like what will we learn that they need, or what are their biggest constraints?
I mean, look, we know Anthropic has done far better over the past few months than OpenAI. And when I look at Nvidia's exposure, it probably is more skewed towards OpenAI and, Meta and those frontier labs compared to Anthropic, where Anthropic has so far relied mostly on Google and Amazon for their training and inferencing. And so from that perspective, the shift in model providers and, Anthropic gaining the lead and obviously Google token consumption being off the charts kind of goes to show maybe, Nvidia may have some pressure in terms of their model exposure. But like I said, when a market is growing that fast, I mean, Nvidia has a lock on the TSMC supply, and that is where everyone will still continue to buy Nvidia's chips, regardless of what is going in the model race.
Hey, Mandeep, just quickly, to Scott's point before about some of these chip makers, should we stop thinking about them in the cyclical way that we typically do for this cohort?
I mean, not until we close this 7x demand. So we know what the demand level is, and we know how fast the capacity is ramping up. Until that narrows, I think there is still a decent runway, but we know once we are close to equilibrium, the semi stocks would have probably moved by that point. So that's what I'm on the lookout for, is the gap between right now, the capacity is expanding, maybe 2 times, and the demand is almost 7 times. And that's where you want that narrowing of that gap between supply and demand to figure out when this will end.
Scott?
Yeah, so I mean, we're used to this differentiation within the semiconductor component, right? So the flash memory and related companies, historically, they've been viewed as, let's call it, more cyclical. And
commodities.
Commodities, if you will. And the moment you begin to see pricing pressure move and demand increase, the expand capacity, and that begins to get you to the end of the cycle. The issue, and one of the tricks here, is going to be, okay, do you get that historic level of cyclicality, or do you find that there's a new continuum here, right? Where, yeah, granted, Mandeep is right. At some point, the spending surge is behind. You're going to get some flattening or some rolling over. But again, timelines here. Does that take us all the way back down to the throes of a traditional cyclical downturn? Or is there a different level of stability that unfolds? If that's the case, then you can argue for higher through cycle valuations, which would say that a lot of the semis that are still trading as if it's a cyclical phenomenon still have room to re-rate.
It's been so interesting. Scott, thank you so much for joining us this morning. Really appreciate your time. That's Citi U.S. equity strategist Scott Chronert and Bloomberg Intelligence Global Head of Tech Coverage, Mandeep Singh. Mandeep, thank you very much. Now, we discussed the high bar for Nvidia earnings next hour with Goldman Sachs analyst Jim Schneider. That's in hour 2 of Bloomberg Open Interest. This is Bloomberg.
This is Bloomberg Open Interest. Let's check on what's going on in terms of stocks here. 25 minutes into the session, we're looking at gains on the S&P 500 to 73.78. The Nasdaq up back over 29,000. It was briefly after those two indexes came down yesterday on rates concerns, higher rates, on oil concerns, higher oil. We're seeing those two things turn around now. So you can see here's the long bond just down a little more than 1 basis point, still at 517, but we have the 10-year also down, really rates down across the curve, and crude down. Brent crude at 108.79. We also have Nvidia as really a focal point of this market today, even though earnings don't come out until after the closing bell. So Nvidia shares not doing a lot, up about 1/3%, but it's a $5.3 trillion company. Google down just about 1/4%. Intel gaining 5.5%. The chips are doing well today. So Intel, Micron, and really across the chip sector, you have gains that could break a 3-day losing streak. I think Ed Ludlow was pointing out that since Friday, the SOX index is close to correction territory. So it's been an insane move, but that on top of crazy climbs as well. Target now down 7.33%. Earnings impressed the street. The shares were up in the pre-market, but then the CEO on a conference call said cost pressures are going to start to hit. So now Target is down. TJ Maxx is up, and we just had Romaine Bostic from the Close On pointing out that, in tough times, people trade down to TJ Maxx, so it could be a beneficiary. Coming up in the next hour, Indrani Day on a narrow market breadth this earnings season. Plus, the CEO of Hasbro joins us on the cost pressures related to its toy business. The market thinks they're sufficient, and the shares are down 9%. This is Bloomberg Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Dani Berger, on track to snap 3 consecutive days of losses, all ahead of the big earnings after the bell today.
I'm pretty hyped up.
For Nvidia or just in general?
I mean, just in general.
Because the Knicks won with a big comeback.
Because of that? No, not because of that. Really because of Nvidia, right? We're going to see this Tom Ford snake leather jacket and his high-end Allbirds shoes, whatever they are. Wherever he got those. Nvidia earnings could determine whether the chip rally still has room to run. It's running today, or reignite fears of a bubble.
Goldman may take a leading role in the biggest ever IPO. SpaceX set to file publicly as soon as today.
And state primaries test President Trump's grip on his Republican base ahead of the midterms.
And we begin with Nvidia earnings, which could validate the massive chip rally. Citi strategist Scott Chronert weighed in.
Let's be very clear about what we're looking at with the S&P 500. It's a bifurcated market. You have to make 2 market calls to essentially get the right perspective on this. You got half of the index that's trading off of the AI theme. I think that's pretty well identified at this point.
Joining us now is Indrani Day, head of global investment research at FTSE Russell. Indrani, great to see you this morning.
Thanks.
And look, this is a market that's been able, maybe with the exception of a few hiccups in the past days, able to fight higher energy, higher yields because earnings have been so strong. So how crucial is it that we get a big showing from Nvidia today?
So in broad market time, I would say this, that yes, it's true, despite the immense risk in the macro backdrop, equities have really had a strong rally. And there are 2 or 3 things, 2 good things and 1 risk concern that we have out there. Earnings growth is very strong. And year to date, valuations have really re-rated so that markets are much better placed on the valuation front today. Having said that, the rally, and this I'm talking globally, it's become so narrow. We like to say that the market is running out of breath. It's getting narrower and narrower. And I just throw one statistic. if you see the year to date, and I'm talking returns for the FTSE all worlds, around 35% have come from just 13 AI or semi companies. 13 companies is just 0.25 percentage points. If you see the April rally, 50% of the returns came from those 13 companies. If you see May, 100% of the rally has come from those 13 semis or AI companies. It's getting narrower, and that is something that every investor needs to be cognizant of.
So the rally is narrow, and we can obviously feel and see that on the Bloomberg terminal. But what about the rest of the index? I mean, aren't we seeing margins still expand for the vast majority of S&P 500 companies? I mean, earnings growth has been amazing for the whole market.
Yes, let me take it on a global scale, because it's true that globally, if you look at the 12-month forward earnings, just in the last 3 months, those earnings have expanded about anywhere between 5 to 6 percentage points, with the growth in earnings expectations being particularly strong, and Korea and Taiwan, Japan is strong, Brazil is strong, Mexico is fairly strong. So it is true that there is earnings growth, but one has to look for these drivers. AI is certainly a driver, but there are other drivers forming in the market. Two of them are the commodities, and the third big theme in the market is this whole onshoring and reshoring that is leading to a resurgence or potential resurgence in manufacturing in many parts of the world. One of it being Europe, the whole Made in Europe concept that they just passed with the Industrial Accelerator Act in March of this year. It could have big reshoring implications. Mexico is benefiting from that reshoring too. So AI, commodities, strategic onshoring or friendly shoring, these are three themes that are leading to pockets of strength and margin expansion for sure.
One of the interesting things, Bank of America recently had their fund manager survey that they published yesterday. For one, you had a huge and record allocation moving into equities, but you also had 40% of respondents saying that they saw a second wave of inflation as the biggest tail risk. Are those two connected? Are people starting to think, or maybe they have for some time, that equities are the ultimate inflation hedge as earnings keep pace?
Yes, that's a very good point to make, in the sense inflation is really becoming a concern right now. It's no longer about inflation expectations going up. You're seeing actual inflations come in higher, which is why you're having this huge bond sell-off. Your 10-year long yield sovereign yields are anywhere between 1 to 3 decade high across the developed world. That is certainly something that can impact equities. So yes, it is something to be of concern. Having said that, equities are an inflation hedge. So parts of the equity world where revenues can keep growing, where margins can keep expanding, and for that right now, it is important to think of the structural thematic drivers. It's AI. Who's benefiting from AI? Because the AI story is becoming more and more granular. Hardware versus software, it's hardware. Within hardware, if you're doing CapEx, is there a direct link to the revenue? It's not just about doing CapEx. So the AI story getting more granular, the commodity story getting more focused on energies, food, critical minerals, things like that. And where is onshoring or strategic onshoring happening means there are potential tailwinds both for return on equity or margins to increase and valuations to potentially go up.
So, but to be clear, the AI CapEx story expands far beyond just the hyperscalers, right? Communication services, far beyond IT, hardware, chip makers, because we're looking at a company like Caterpillar as an AI play now, a company like Ford as an AI play now, a company, I can't remember the name, but one that makes boilers, right?
Wilcox.
Yeah. So like this CapEx is driving margins in like 7 out of the 11 S&P 500 industry groups to expand.
That is true. The whole AI CapEx story is now look at the picks and shovels, not what is necessarily immediately associated with the word AI, but look for the pickles and shovels and the deep in the weeds of what goes into AI. That is becoming critically important. I would also argue that we are yet to see this, another effect of the AI, the productivity boom. It is very well possible that this AI story, while it looks narrow today, the next wave is going to come from the huge productivity boom, not just in the United States, but across the globe. So the AI story is getting more granular, but look for the picks and shovels and where is the CapEx in any way connected to the AI story. it's along the themes of why is listed infrastructure doing so well, because data centers coming up in many other parts of the world. So think through deep in the weeds of the AI story and the second and the third order beneficiaries of AI. That would be one way to look at it for sure.
I really appreciate your time here, Indrani. I wish we could spend more time with you, Indrani Day there of FTSE Russell, talking to us about the rally that we have been watching and continue to see today. Although we're not at the high, we got to 75.01 last week at the close. We sold off a bit on Friday. We sold off a bit yesterday, but we're coming back up about 0.2% today. Let's get a look at some of the single stock stories we're following for you this hour. TGT, Target, boosted its forecast after posting the best comp sales growth since 2022. So the headline on the Bloomberg terminal this morning was, a turnaround is afoot at Target, and the shares were up in the pre-market. But you can see now they're down 7.33% because of that inflation effect that Indrani was just talking about. The CEO on a conference call saying costs are going to start becoming a real problem.
And Intuit reportedly plans to cut 17% of its workforce, according to Reuters, as it streamlines operation and leans into AI. It's one of the rare cases that type of headline is sending shares lower. Intuit selling off more than 3%.
Meta is beginning to restructure with plans to cut upwards of 8,000 jobs starting today. This is not a new announcement. We knew that this was happening. And, of course, yesterday they said they're going to move about 7,000 over to new AI positions. But it's part of the bigger story that even if we see increased productivity, we could also see a lot of people simply out of work. I'm just talking about the lower value human capital, you know?
To be very clear, you're quoting Standard Chartered. Or maybe
Yes.
you think that too, I don't know. For what it's worth...
I'm taking a quote out of context.
Yes, of course. Yeah. For what it's worth, Jeff Bezos was on CNBC this morning and basically saying that we're going to have a labor shortage because people are going to drop out of the workforce because AI is productive and you won't have enough people working, which I don't really understand the mechanics of that. If I'm like, oh, AI is so productive, I should quit.
Well, if you
I don't totally understand.
I mean,
that.
I actually kind of get that. And by the way, I saw that interview. He is a transformed dude visually. But his point, I think, is that you can start to use AI to make money, and more people are using it to organize their lives.
Yeah, but that's not making money. That's just efficiency.
But maybe you find ways to do it, right?
So, like, you stop joining me here, and it's just like an AI hologram of you, and you go home and stop working?
I mean, if I could find a revenue source from
but that's not a labor shortage, though, because work is still being done. You've just replaced something that you were doing with AI.
Yeah, I guess the point is that he'll have a problem hiring people
because less people are in the workforce.
Exactly.
Yeah. Okay.
Goldman Sachs is said to be leading SpaceX's mega IPO. SpaceX is expected to file publicly as soon as today. It's aiming to raise $75 billion at a valuation of over $2 trillion. Joining us now to talk about that is the man who knows everything about the cap table and the rocket engines, Bloomberg Tech co-host Ed Ludlow. So, Ed, I love this story because we're going to see a Starship launch as well. And if I'm not mistaken, last time it blew up on the pad, and that could really dampen optimism, exuberance for this IPO.
Not last time, but historically it has. And just remember, what is the point of SpaceX doing the biggest IPO of all time? It is to get capital to fund orbital data centers. And Starship is the launch system, the only launch system on paper that is capable of deploying those satellite form factor data centers at scale based on, its payload capacity. And so, the reporting is very interesting that Goldman Sachs is lead left and that Morgan Stanley is a lead investor. But the hierarchy is definitely more nuanced than this, right, for the biggest IPO of all time. And it has always been, in the many months we've been going back and forth on this, that the economics of this will be much more equal amongst the banks, because it has to be, given the structure of what SpaceX is trying to achieve here.
Ed, when we get this listing, what might we learn that we don't already know?
Oh, I mean, everything. The real terms, financials of this company, there's quite a lot known that the revenue picture has changed, where Starlink, which is its constellation-based internet service, has vastly overtaken the business of launching stuff into space, right? Musk has always talked about there's a cap on how much money you can make by having a rocket that carries other people's payload. Right, so that's the thing, but the bottom line take on that is interesting. The story you know, we were really early out the gate in saying this IPO is about space-based data centers. And why on earth would SpaceX need $50 or $75 billion? Why would they even go public? Elon Musk doesn't like being the helm of a public company. They need the capital to buy chips. It's a very simple formula where the chips go into the satellites, they are data centers, but they are for running inference. And so, you know, that business plan, but also the total addressable market is the first place people will look.
Is this not going to get us any closer to Mars, Ed? That's what I'm hoping for. I feel like that could be a great ticker, although the ticker is already taken, and I'm hearing that SPCX will be the ticker.
Yeah, on the NASDAQ. And so every IPO needs a story. And whether it was the bankers that dreamed up space-based data center, or it was Elon Musk himself or one other SpaceX executive, that's the story they're telling. That the future opportunity and the addressable market is data in space, not necessarily the rockets themselves. But SpaceX's overriding mission, remember when I used to come on this program and we also kind of awkwardly smile when I said this out loud? I'll say it again. SpaceX's kind of founding mission, its core belief, is that humans as a species should be multiplanetary. They should be a spacefaring species and civilization. And so, like, Musk has maintained that he wants to get humankind back to Mars. And again, on paper, Starship, the reason we'll tune in tomorrow night if it happens, is because Starship on paper is the only thing that can achieve that.
All right, it'll be exciting for sure, Ed. I'll be watching and I'll be live texting you the whole time. Bloomberg Tech co-host Ed Ludlow. His program coming up in just about 45 minutes. They'll be covering the SpaceX IPO, everything you need to know on that, as well as I'm sure that Ed will be covering the launch as well. Coming up, Live Golf may be forced to throw in the towel after losing Saudi funding. They thought they had money forever, and it turns out it's run out. We'll talk about that and the world of sports next. This is Bloomberg Open Interest.
Live Golf starting to lay the groundwork for a potential U.S. bankruptcy filing. Sources tell Bloomberg that the league is currently looking for money after its main backer, the Saudi Public Investment Fund, pulled its funding. Joining us now is Randall Williams, Bloomberg Sports business reporter. I mean, who would back this behemoth, if not the Saudis?
It's a good question. I mean, when you have $5 billion that have gone into a company and they haven't returned a profit, now Liv, of course, has made money, but not the entire $5 billion back. So you can imagine going to market saying, listen, we spent $5 billion. We're still growing, but not at the pace that $5 billion has been spent. It's going to be hard to find someone. And so that's what they're preparing for, is in case they don't find these backers, bankruptcy is an option. So
this is, to me, a fascinating story of, failure for the players who decided to leave the PGA and go there. Who has the most egg on his face here? I mean, who's...
I think that's an interesting way of looking at it because of the fact that they were paid a boatload of money that some of them may not have been able to get at the PGA Tour.
Fair.
With that in mind, I do think that players are looking at this and trying to decide what does their future look like. Will they face penalties from the PGA Tour if they decide to rejoin? Now, Liv has not ceased
operations. Will they even be allowed to rejoin?
Exactly.
Right?
And so Liv hasn't ceased operations yet. They're not saying, oh, we're shutting things down. But with all the signs that are pointing at in terms of looking for new funding, in terms of this potential bankruptcy, it's looking like there's going to be a lot of free agents out there that are going to be trying to rejoin the PGA Tour.
By the way, why was this so problematic? I mean, it came with a lot of fanfare, and then we thought PGA and Liv were going to merge at some point. How did this fall apart so quickly?
Well, the PGA Tour made advancements. Like, Liv Golf disrupted things, and they pointed out some things that on the PGA Tour side that were probably inefficiencies. And then the PGA Tour went and got some money, and they evolved. They put a lot of the things that the players were pointing out into effect, and now they're winning again. And I think Liv Golf has been, unfortunately, they have not been the beneficiary of the PGA Tour success.
I want to talk a little bit about other sports and team valuations.
Sure.
Because yesterday, the Business Week program was interviewing Jess Smith from the Valkyries. They're playing, I think, Thursday night here against the Freedom. This is a WNBA team. And they Sorry,
Liberty.
Did I say freedom?
Yeah.
What?
I mean, it's all the same thing.
By the way, that's at the Barclays Center. You know, they don't play.
Oh, really?
They don't play at the Garden.
Oh, that's a
the
shame.
Liberty
They should
plays
play
at the Barclays
It's a
Center.
different story for another day.
Yeah, but the point is, this Golden State Valkyries team is already a behemoth, already a contender in the league, and also already worth $1 billion. Listen to what Jess had to say.
The opportunity is really that there is a unique audience, as well as an audience to convert that might be a traditional sport fan into this incredible product for those that are growing with it, as well as to create something new. You know, I think women's sports specifically, and the WNBA is a leader here, is a mix of sport and purpose and culture. So yes, you're focused on selling out your games, creating the best fan experience, but you're also focused on building community and connection in a much deeper way. And how you're doing that and how you're building business around it is really important.
So I know the WNBA is not new, it's 30 years old, but are these valuations just starting to ramp higher? Is this sport gaining a ton of
It is gaining a ton of steam. I would say that the Warriors and the Valkyries are unique because of what they have, the surrounding real estate, the new stadium, all of those things. Jess is incredible. What the Warriors owner has built, Joe Lacob has built there, has been transformational on both sides. And so when you combine that with a new media deal, with a new collective bargaining agreement, everybody's getting paid. And so valuations are continuing to rise. You look at the Fever, you mentioned the New York Liberty, they're up there as well. It's just about maintaining that over time.
And for all these NFL teams that are starting to get more buyers come in.
Yeah. We reported yesterday about the Cleveland Browns selling a 3% stake now. It'll be 10% over the course of many years when it eventually closes. And that was at a $9 billion valuation. It's crazy to think a team in Cleveland would be worth $9 billion. But but the reality is the NFL business is that healthy. And the Cleveland Browns have a new stadium coming that they're building with surrounding real estate. And so you're going to have private equity that wants in, and Arctos has the most stakes across the NFL.
I was really waiting for Matt to just be like, of course it's worth that much.
I mean, I'm from Columbus, so I don't feel
I don't know the
that close to Cleveland.
know the intra-Ohio politics.
But Cleveland rocks. I mean, come on, LeBron.
You got to get excited for Shador.
Yeah.
You got to get excited for Shador.
All right, Randall, thanks so much for joining us. We got to do this more often. Bloomberg sports business reporter Randall Williams. Later on Bloomberg Deals, by the way, that's an hour-long program every Wednesday at noon, hosted by Dani Berger. She has a conversation with the CEO and chair of Lazard, Peter Orszag. So we're looking forward very much to that.
Thank you. Now some high-interest stories.
Let's get to high interest. Look at what's making headlines around the world. Iran warns it would retaliate beyond the Middle East if the U.S. or Israel restart attacks on the Islamic Republic. The warning follows renewed threats from President Trump, who said the U.S. may have to give them another big hit if Tehran rejects American peace terms. Speaking to reporters in the past hour, Trump did say he is in no hurry and also said Iran is decimated. An Ares fund and the Scion Group buy 12 U.S. student housing properties for about $910 million. The sites are near schools, including the University of Notre Dame in Indiana, Ohio State, the Ohio State University in Columbus, Ohio, and James Madison University in Virginia. Institutional investors have been drawn to student housing, which is often seen as recession-proof. And Barney Frank, the Democratic congressman who found himself on the front lines of the government's rescue of the U.S. financial system in 2007 and 2008, has died. In April, it was reported that he entered hospice care at home while dealing with congestive heart failure. Frank was the chair of the House Financial Services Committee in 2008. He co-wrote the Dodd-Frank Act, the most sweeping change in U.S. financial regulation since the Great Depression. He was 86 years old.
I check on your markets almost an hour into your trading day, and we are snapping 3 days of losses. We're up 0.5% for the S&P. NASDAQ rebounds with the chip makers doing well today. Aiding that are yields and oil finally starting to come in. 10-year yields are down 3 basis points. Brent crude falls nearly 4%, but it still is trading at 107. We're going to get a 20-year auction later today. Coming up, toy maker Hasbro continues its push into gaming and digital franchises. The CEO joins us next on Bloomberg Open Interest.
Hasbro shares are slipping despite strong earnings and maintained outlook. The company doubling down on gaming and digital franchises while navigating tariff pressures and softer consumer spending across the toy industry. The CEO, Chris Cocks, joins us now. And Chris, it's great to have you on the program. Great to talk Hasbro again. I wonder if there's a risk that many investors don't really understand your business model and the products in which you see the most growth, since they're concerned about more concerned about maybe the petroleum-intensive toys with which they associate normally Hasbro and the industry.
Yeah, well, I'd certainly say we have some exposure to petroleum, but it's relatively light. The majority of our business is games, which are made of paper and frankly domestically sourced, and then licensing and digital, which is just bits and bytes. So, that's the vast majority of our business and the vast majority of where our growth has been coming from. And, you can never make promises and guarantees about the future, but when you look at a business like Magic, it's grown on average 16% per year for the last 10 years and just clocked in over 20% in our first quarter. So we're starting off the year pretty good. Yeah, 26% was the growth at Wizards, which, because I'm familiar with the business, I have been at your headquarters, Wizards headquarters in Seattle, as well as your headquarters here on the East Coast. I understand how much that accounts for. I think more than half of quarterly revenue and growing at a strong clip. Have investors just misunderstood the story of Hasbro? I'm not sure. I don't think I'm just looking, Chris. I'm looking at the 9% or now 7.5% drop and wondering why the sell-off. We're worried about inflation. We're worried about the consumer. But it seems like those who are buying your IP continue to do so. Well, I would look at a down day like today as a buying opportunity, frankly. I think we have a lot of strong structural advantages. When you think about Hasbro, you need to think about it being a collector's, gaming, and IP company, and those are all growth businesses. We frame our opportunity in terms of audience and category in an acronym called GEM Squared. And so those are categories that are gaming-driven, entertainment-driven, multi-purchase, and multi-generational. In 2025, categories that we define as GEM Squared were up 22% versus the rest of the toy industry was down 3%. And most of our capital, most of our brands, most of our growth is invested behind those GEM Squared insights and those GEM Squared brands. You saw it in Q1 where we grew 13%. You see it in our guidance where we're projecting kind of a mid-single digit growth rate for the company. And you see it in the bottom line where our profits have never been stronger and our profit growth and our profit margins are some of the best in the industry.
Chris, I think, if I may, at least it seems like the analyst community's reaction is kind of what you're talking about, this idea that your growth has been so strong, 13% in the first quarter. Look at last year, the success and growth of Magic the Gathering. Why is there like a slight step down to the single digits? What sort of changes as the year goes on that you don't get that low teens growth and success that you've seen?
Well, I think we're a diversified business. I think, we always start the year with a tempered outlook about what we think the business can do. And, we like to underpromise and overdeliver, which is something that I think we've done now for 9, maybe 10 quarters and consistently. I think that's good for our investors. I think that's good for our internal teams. And I think that's good for our fans. We have, I guess, a bit of a fanboy in our producer, Will Shaker, in the control room. He's writing, tell me about the movies, guys. So you have a big theatrical slate coming, right? Star Wars, another edition there. Toy Story, I think it's the 5th one, Spider-Man, Avengers. What do you expect from that in terms of toy sales, which are, obviously the resin, the petroleum-based products are getting hit with cost pressures, but I would imagine you'll have some pricing power as well here. Yeah, and we do. We think $100 a barrel oil has about a $30 million cost headwind for us, but
I think you have to look at that in the context of a business that generates $1.4 to $1.45 billion in EBITDA per year. So it's a relatively manageable set of cost pressures for us that we can offset inside of a large and diversified set of operations. And I think you're right. Our entertainment slate is second to none. We've got The Mandalorian and Grogu opening this weekend, the first big new Star Wars movie, I think, in 7 years. So far, toy sales for that have been selling at a robust clip, including one of the coolest toys we've ever made, the Ultimate Grogu, which is a $599 super high-end animatronic collectible. Then we have Toy Story 5, which is always great for our official company mascot, Mr. Potato Head, and his family. Those sales always go through the roof on that. Then we have Spider-Man, Brand New Day, which first Spider-Man movie in a couple years, and based on early previews that we've seen, it looks fantastic. And then we're going to cap the year off with the Avengers Doomsday, which is like bringing back all the original cast and really propelling that story forward. So I think from an entertainment perspective, certainly in the short term, we look fantastic, and I think the story only gets better in the midterm. Next year we have the Star Wars 50th anniversary, we have Star Wars Starfighter, we have more Marvel superheroes films, and then Hasbro's entertainment slate is just starting to cook. We're going to have, I think we have something like 60 projects in the hopper, and next year we'll have the debut of our new Magic animated series, which I think will help propel Hasbro's biggest and most profitable brand to all new levels.
You should have, by the way, some kind of golden ticket game where the winner gets to see your headquarters, the Wizards' headquarters on the West Coast.
And then they get to own it and run it.
It's an amazing place. I was really excited to get to spend some time there. I want to just ask you finally about Monopoly, because it's an age-old property, obviously, and you've done well online and digitally with Monopoly Go. But Will says there's potentially a live-action feature film coming out. Can you tell us about that?
Oh, yeah. There's a live-action feature film, which we're partnering with Lionsgate and Margot Robbie's Lucky Chap production. That's been in development now for a year or so, so that should be pretty exciting. And certainly Margot is a fantastic talent, both creatively and as an actress. And then, Monopoly Go continues to cook with gas. That's the biggest mobile game in history. It continues to deliver. To put in context what Monopoly Go does for us, it's basically the equivalent of 2 blockbuster movies worth of licensing revenue per year to us. And that's an annuity that's not just a one and done. That's going to be an annuity that's going to stick with us for a very long time. And I think it just shows some of the innate advantages inside of Hasbro. We're very diversified. We have toys, we have games, we have collectibles. We have a huge digital game business in licensing, a growing one in first-party publishing. And then we have this great licensing business overall that spans over 1,000 partnerships, over 5,000 collaborations, and is combined when you think about digital plus our physical licensing. It creates merchandising of $16 to $18 billion of Hasbro branded merchandise per year, in addition to the $4-ish billion that Hasbro generates per year.
I would say, I don't know if a Monopoly movie is for me, but I would have said a Dungeons and Dragons movie wasn't for me, and I loved it, and it was great. So maybe that says something. Chris, always a pleasure to have you on, Hasbro CEO Chris Cocks. All right, let's get a check on your markets this morning. We're still rallying. The NASDAQ at the highs of the morning ahead of Nvidia's earnings. We're up 1%. That's after 3 consecutive days of losses. It's helping that yields are coming in 5 basis points or so for the 10-year yield ahead of a 20-year auction today. And Brent crude coming in by 3 3/4%, Matt.
You love the Dungeons and Dragons movie?
It was so good.
Really?
It was really good.
Did you see it on a plane?
I saw it in theaters.
In the theater?
Yeah. It was a rainy day. I had nothing to do, so I saw Dungeons and Dragons, and I I loved it.
All right, we're learning things about Dani today. We're learning about Toll Brothers as well. The home builder raised its full-year guidance as orders hit their highest level in 2 years. I guess consumers are getting used to these interest rates. Toll Brothers stock up more than 6%.
Lowe's maintained its guidance, but comparable sales came in just below estimates, shares falling off the back of that.
Kava, which Dani also loves, raised its annual sales outlook and saw a rebound in demand despite consumers getting cautious around budgets and commentary around slop bowls.
Just get me a slop bowl, sit me down in front of the Dungeons and Dragons movie, and that's a whole day for me. Coming up on the show, Goldman Sachs analyst Jim Schneider expects a beat and raise from Nvidia today. He's going to join us next. This is Bloomberg Open Interest.
We have the largest supply chain in the world. Our partners have done a great job securing supply for us. And so all of the pieces go together. The silicon photonics is lined up. Everything is all lined up. It's just that the demand is much greater than the overall capacity of the world.
Nvidia CEO Jensen Huang speaking to Bloomberg on Monday, and the world's largest company will be reporting earnings after the close and aims to keep the AI rally going. It has a high bar to meet with sales growth expectations above 80% year over year. Joining us now is Goldman Sachs semis analyst Jim Schneider. He has a buy rating on the stock with a $250 price target. So Jim, if all expectations, yours including today, is a beat and a raise, and we've already baked in 80% sales growth, what does it take to get this stock to have a positive reaction, to actually pop after they report results?
Yeah, it's a great question on top of many investors' minds. I think we've had down reaction that last 3 out of 4 quarters for the stock. Partly not because the numbers were not good, because the numbers have been very, very good, over 80% growth, as you said. But I think there are some questions that have, some investors have questioned the sort of sustainability and durability of those earnings. I actually think that we're going to not only have a beat and raise for this quarter, but that's in fact sustainable into next year. Our estimates for next year are over 30% above the street. And I think there's been a concern among the hyperscalers and model providers about the sustainability and durability of their spending. And that kind of becomes a concern about Nvidia as well. I think the way I'm seeing it is, and we wrote out another note a couple weeks ago on this topic, we actually think that as the costs come down for the tokens that everyone is consuming very quickly by about 70% a year or better, that's being given by the chip providers like Nvidia and Broadcom.
How are the cost of the tokens coming down? Is this just efficiencies that these companies are eking out?
Yeah, it's architectural efficiencies, both in terms of the fundamental chip compute, but also the networking between all of the different chips in the data center or cluster within a data center.
So, I mean, one concern that Dani's had lately is inference costs.
Yes, well,
right?
Uber ran through their entire year's budget in just a couple months of inference costs.
But that kind of concern will dissipate, I guess, over the coming years.
We think so. And in fact, we show in our recent report, these token costs are coming down by the chip providers by about 70% per year. That's very rapid. In fact, that's much more rapid than we saw during Moore's Law, which was 10, 15% kind of annualized cost declines. This is much quicker than that. And so I think that really, what it's really doing is it's driving what has been rather a tepid gross margin for the hyperscalers and model providers, where now token costs are actually coming down faster than token price. And those two things cross. Token cost falls below token price. You start to get positive gross margin and better unit economics for the hyperscalers. That makes their spending more sustainable.
I have been thinking a lot about Nvidia chip sales to China over the past year, and I think it's pretty clear that the Chinese want to avoid taking Nvidia chips, giving them more revenue, and obviously foster growth in their own chip companies at home. So that takes the $50 billion TAM story off the table, at least to some extent. How can their total addressable market grow from here?
It's more around the core US-based hyperscalers and model providers. In fact, today's spending among that cohort of companies is more than 20 times today's opportunity in China. Not that we don't believe that China opportunity long-term will be very significant, but today it's quite small in comparison.
So if you look at where Nvidia is trading, I mean, it's still, 26.7 times forward earnings. It's not cheap, but it is cheaper relative to where they have been in history. As recently as the end of last year, it was trading at 31. Back in 2023, it was trading at 43 times earnings. What's changed for Nvidia that it's not trading as richly priced to earnings as it has in the past?
Well, I think part of it is law of large numbers. Part of it is law of large stock. But also, there's been some concern, as I said before, around the sustainability of that future spending and whether you can really grow at these rates on top of these very, very large numbers we're at today. So, we have close to 80% revenue growth again in 2027 off of these numbers. And as I said, we're 30% above the street. So if that turns out to be true, the stock is actually much more attractively priced than that.
All right. We hope for your sake that it does turn out to be true, Jim, and I guess for this broader market as well. Jim Schneider there of Goldman Sachs. Hope we can get you back on the program quickly. Coming up, another major primary win for President Trump. What the Kentucky race says about his grip on the Republican Party. That's up next. This is Bloomberg Open Interest.
The president's endorsement is the most valuable currency in a Republican primary election. I'm cautiously optimistic that the president, the Republican National Committee, and the work we do here in Georgia, we're going to be able to defy history and hold on to the House.
And that was Georgia Republican Party Chairman Josh McCoon on the GOP primaries. Yesterday, President Trump's handpicked candidate Ed Galrine defeating Congressman Thomas Massie in northern Kentucky, another sign of Trump's continued grip on Republican voters. Joining us now from Atlanta is Joe Matthew, co-host of Balance of Power. And Joe, we have kind of two competing storylines here. One is the dwindling popularity, at least of President Trump's policies or war nationally. The other is his continued power over Republican voters, over his base in these primaries. How do you see it?
Yep. It's a pretty firm grip. Obviously, after what we saw last evening in Kentucky, that wasn't even close between Massie and Galrine. It was a 10-point spread. Matt, so pretty remarkable. And the amount of money that was spent in that race made it the most expensive House primary in American history. Can you imagine $32 million spent on a primary in the United States House? So, look, Tom Massie is obviously not going to be keeping his seat, but he's got 7 months left in the House, and some of this stuff can start to splash back. We also saw this in Louisiana, where President Trump dispatched Senator Bill Cassidy, a longtime popular Republican, a chair on the committee level in the House. He voted last evening for the War Powers Act that he probably wouldn't have voted for in another world. So the president is spending a lot of time with this sort of vanquishing of people in his own party. But some officials in the Republican Party are concerned that he's not talking enough about beating Democrats. He's actually talking about beating Republicans.
Well, maybe in the case of this election in Kentucky, it's a solid place that tends to go to the president. What about a race like in Texas, where the president has now backed in the primary the Texas Attorney General Ken Paxton? If he is to win, does that set up a harder path forward to beat the Democrats when the race finally comes due?
That is the conventional wisdom, Dani. You're putting your finger on it here. And that was kind of a jaw dropper yesterday to think that the president of the United States would not endorse the longtime incumbent who at one time was considered possible majority leader of the Senate. John Cornyn has made it very clear that the president made the wrong choice here in picking Ken Paxton, the sort of MAGA candidate versus the establishment candidate. And yes, James Talarico is the Democrat who actually is threatening to flip this seat. And the conventional wisdom is that Cornyn would have made that more difficult. So if you have a Senator Talarico, there's going to be a whole conversation again about candidate quality in the age of Trump.
Joe, what is the reaction? I'm curious about the reaction in the Republican Party about this $1.7, $1.8 billion, what's being called a slush fund that resulted in the settlement between President Trump and his lawsuit against his own IRS.
That's right. Would also keep the IRS from auditing his tax returns again. This is a tough pill to swallow. If you are a Republican on Capitol Hill, Matt, they're already dealing with $1 billion request to build a ballroom and help secure the president of the United States. trying to push that into a reconciliation bill that might not make it through this week. So this is a whole other level with the president settling here with his own DOJ. I'll remind everybody that that's taxpayer money that may well end up in the hands of January 6 offenders, depending on what this council, this board that will be appointed by the DOJ decides.
Well, and potentially unconstitutional as well, right? I mean, Article 1 says that Congress has to agree to spending. Certainly of this magnitude, you would think some people on Capitol Hill will push back. Are they going to? Will the Supreme Court eventually hear this case?
Great questions, and we don't know. But I'll point everybody to a debate that's going to start right now, starting today in Washington, and will likely resolve into what they call a votorama around the reconciliation bill tonight or tomorrow night. It's going to be an all-nighter, Matt, where Democrats and Republicans can throw any amendment they want to try to get action on the floor. And Chuck Schumer is going to make this a real issue to try to pin down Republicans on both of these stories and get a yes or a no vote on the record to see where they stand. That could be fraught for those running for re-election.
All right, well, I'm looking forward to my favorite program. Joe Matthew, co-host of Balance of Power. You can catch him at noon on Bloomberg Radio, at 1 o'clock on Bloomberg Television, and then again at 5 p.m., the late edition, the hardest working man in television. Their lineup today includes Aflac Senior Vice President Keith Farley, Truist CIO Keith Lerner, and Georgia Tech Professor Animesh Garg. So definitely a program you don't want to miss.
Just quick check on markets as we head to the end of the hour. A rally continues ahead of Nvidia earnings. NASDAQ at the high of the day up 1.2%. The S&P 500 just under 100 points away from an all-time high. 10-year yields come in by 6 basis points as Brent crude falls about 4%. By the way, today is Wednesday, and you can catch me on Bloomberg Deals in just about an hour's time. Tune in for my conversation with the Lazard Chairman CEO Peter Orszag. We talk about AI, about markets, about inflation, one you're not going to want to miss.
It's lucky that there's 3 hours of Balance of Power. See, I can afford to miss 1 hour. I'll watch your program at noon,
right,
and then I go straight to Joe and Kaylee. Tomorrow in Open Interest, Dani and I are back to celebrate Thursday. This is Bloomberg.